So what does the IMF crisis mean for U.S. stocks, if there is a correlation? Joining us, Jamie Cox. He's managing partner at Harris Financial Group, and Keith Springer is president of Springer Financial Advisors. And I think, gentlemen, I guess taken by itself, you could find some things, but we have our own issues right now in the U.S. to deal with. We've hit our own debt ceiling here just today, and the Treasury's having to take measures to work around that. We have the flooding issue with the Mississippi and its potential impact on our economy as well. But having said that, Keith, can you look for things that is happening with the IMF that could have an impact on our own markets here?
Well, whenever there's a crisis in the developed world, a financial crisis, it affects everybody. The problem with us here is we really are having an information lull, almost like an earnings hangover. We had a great earnings season. That really is what pushes stocks higher. And now that we don't have any news from earnings pushing stocks higher, we're focusing on some of the other issues, and particularly the IMF. And anytime you have a crisis over there, I don't think anybody, Bill, believes that we're not going to fix it. They're not going to come to a conclusion, but we're focusing more on it. And the more there is turmoil, the more our stocks are going to be affected. If it looks like we're not going to come up with a solution pretty quick, you could see our stocks get hit pretty good.
What do you think, Jamie?
I think it's a big distraction. It's a shame that we have all these problems with European sovereign debt, Greece specifically, and we're talking about things about some person's alleged affair. It's really a shame we have to deal with that kind of thing. And in our country, I think the debt ceiling is a really big problem. I mean, if we don't deal with these things seriously pretty soon, I think we're going to lose our credibility as a nation. And I think that's probably the biggest thing. And our currency, unfortunately, is really being smattered as a result of us not being able to get our fiscal house in order. So I really think that's the biggest issue that we suffer as Americans, is we have a credibility gap, and it's showing up in our currency and is making things for every American out there more expensive, and it's really a shame.
Well, I'm really glad that we've got to the currency issue, because I was wondering, Keith, whether or not one of the biggest impacts that we might see on our U.S. stock market from what's going on in Europe and what's happening with the IMF is that by kicking the can down the road, in the words of one of our other guests, essentially we might eventually see real pressure come on top of the euro, and a much stronger dollar here might hurt our stocks. Is that a scenario that you see?
Absolutely. See, the lower dollar, Mandy, is by design. The Fed wants a lower dollar. We're trying to grow our way out, make our exports cheaper. They're trying to make the dollar lower. A stronger euro is going to hurt that, absolutely, and I think you're going to see a stronger dollar hurt stocks. But I think the biggest thing right now is the QE2, maybe QE mini-me going on. We've got to get the Fed to decide if they're going to continue to stimulate. I think that's what pushes stocks higher. But the currency, by design, is being held lower. Not too low, but it's really not getting crushed. But the Fed does want a lower dollar so we can export our way out of this crisis.
I think the QE2 and the end of QE2 certainly is being priced in right now. I'm wondering whether or not, if there's any sort of word out of the Fed that we do need more stimulus, whether that's actually a bad sign for the market. It shows that the economy is not getting better, and I just don't know whether it's going to be a net negative or a net positive. What do you think, Jamie?
I actually think that the Fed needs to get out of the way. I mean, we're not going to know whether or not these policies work or not until they get out of the way and let markets go on. I mean, the more the Fed is involved, the worse things are. So I think let them get out of the way. Let's let the market do what it does. Let's clear what we need to clear and move forward. Because if we don't, we're never going to know the answer to that question.
Hasn't it only been moving forward largely because of QE2?
Well, if you look at the results, I mean, look what's happened with QE2. It's lowered the price of the dollar, and things that are dollars, very sensitive, have gone up. But if you look below the surface, there's a lot of the economy that's actually doing okay. You factor out real estate, look at industrials and things like that. The lower dollar has helped. However, I really think that we're not going to know the full impact of whether the economy can stand on its own 2 feet until the Fed gets out of the way. We're already super accommodative as it is with zero interest rate policy. I mean, what else do we need? Do we need to continue and continue? If we do, we're never, ever going to get out of this mess. We have to let the markets clear.
All right. Keith, Jamie, good to see you both. Thank you for joining us today. Appreciate it very much.